Right now, as we look at the live ticker, Super Microcomputer Inc., trading under the symbol SMCI, is changing hands at exactly $34.15 per share. The stock is showing some intraday life, currently up approximately 1.65% for the session, oscillating between a low of roughly $33.50 and a high near $34.41. The market is open. The order books are flashing, and we are seeing a volume that is slightly lighter than its 90-day average, sitting around 16 million shares traded so far today. When you look at that green percentage on your screen, the immediate expectation is that the AI hardware trade is back on, that the buy-the-dip mentality is finally paying off for the bulls who have weathered a brutal year. You might look at this price action and think the market has forgiven the company for its past transgressions. But the reality is far more complicated and, frankly, much more dangerous. The reality is that this price movement isn't a celebration. It is a nervous twitch in a stock that is currently fighting for its reputation, its margins, and its place in an increasingly crowded server rack. While the expectation is that a rising tide lifts all boats in the semiconductor space, often dragging Nvidia stock and Supermicro up in tandem, the reality we are seeing in late 2025 is a decoupling. Investors are no longer blindly throwing capital at anything with AI in the prospectus. They are demanding governance, they are demanding consistent cash flow, and most importantly, they are demanding trust. That is the commodity SMCI is currently short on, and that is why this $34 level is such a critical battleground. To understand why this stock feels like it is moving through molasses despite the positive intraday green, we have to peel back the layers of what has happened over the last 12 months. If you are using Schwab Intelligent Portfolios or looking at analysis from Fidelity Investments, you have likely seen the hold or neutral ratings plastered all over this ticker. That hesitation stems from the massive disconnect between the company's technology and its corporate stability. The expectation from the retail crowd, perhaps those trading on Robinhood or using SoFi Invest, is often that Supermicro is a pure play lever on the growth of data centers. They see the expansion of hyperscalers, they see the power demands of training large language models, and they assume SMCI must be a bagger waiting to happen. However, the institutional reality, the view from the desks at Interactive Brokers or Fidelity Wealth Management, is focused entirely on the governance discount. When a company goes through what Supermicro went through in late 2024 and early 2025, with the delayed 10K filings, the resignation of Ernst & Young as auditors, and the subsequent scramble to hire BDO and regain Nasdaq compliance, it leaves a scar. Even though they regained compliance in February 2025 and the independent committee found no evidence of fraud, the market has a long memory. The stock is trading at a PE ratio of around 26x or 27x, which, relative to the explosive growth of the sector, looks optically cheap. Compare that to the premiums paid for Tesla stock or Apple stock during their hype cycles, and SMCI looks like a bargain. But this is where you have to be careful with value. Is it value, or is it a value trap? The market is currently pricing in a risk premium that suggests investors are still waiting for the other shoe to drop, or at the very least, they are waiting for a quarter where the earnings simply blow the doors off without any asterisks attached. Let's talk about the actual business performance, because that is where the rubber meets the road today. The recent Q3 earnings report was a mixed bag that perfectly illustrates the tension between expectation and reality. The expectation was that as Nvidia ramps up Blackwell chips, Supermicro would be the primary beneficiary, shipping liquid-cooled racks faster than anyone else. The reality revealed in the recent numbers was a 15.5% year-over-year decline in revenue to roughly $5 billion. That is a hard pill to swallow for a growth stock. While they beat on EPS slightly in some metrics, the revenue miss signals that the competition is biting harder than anticipated. We are seeing Dell and HPE Enterprise become much more aggressive in the AI server space. For a long time, Supermicro had the time-to-market advantage. They could custom build a server rack and have it on a truck while the big legacy competitors were still in meetings. That gap has narrowed. Online investing communities are buzzing about whether Supermicro has lost its moat. When you have Dell offering similar hardware with arguably better enterprise support and supply chain financing, the customization edge of SMCI becomes less dominant. This competitive pressure is crushing margins. Gross margins have compressed significantly, coming in under 10% in recent reports compared to the 15 to 16% range we saw a year ago. This is the silent killer. You can have all the revenue growth in the world, but if you are slashing prices to keep Fidelity ETFs and large institutional buyers from defecting to Dell, your bottom line will suffer. This margin compression is the single biggest fundamental red flag on the chart right now, regardless of what the intraday price is doing. However, it would be foolish to be entirely bearish without looking at the massive upside, which is keeping the liquidity flowing on interactive broker trading platforms. The company has guided for a massive fiscal 2026, targeting $36 billion in revenue. That is an ambitious number. If they hit that, the current stock price of roughly $34 is absurdly low. This is the curiosity loop that keeps traders engaged. Can they actually pull off a $36 billion year? To do it, they need the direct liquid cooling technology to become the industry standard, and they need to maintain their close relationship with Nvidia. Supermicro has bet the farm on DLC, arguing that traditional air cooling simply cannot handle the thermal output of the next generation of AI chips. If they are right, and if data centers are forced to retrofit for liquid cooling en masse, SMCI is positioned better than almost anyone to capture that wave. They have the manufacturing capacity. They have been expanding facilities in Malaysia and Silicon Valley to pump out these racks at scale. The bull case relies on the idea that the current revenue dip is just a temporary air pocket caused by the transition from Hopper to Blackwell. The argument goes that customers paused orders to wait for the newer, faster chips, and once those supply lines open up fully, the floodgates of revenue will reopen for Supermicro. If you believe that narrative, then buying here is a no-brainer. But if you believe the margin compression is structural, that AI hardware is becoming a commodity, then the $36 billion target is a fantasy. It is also vital to consider the macroeconomic backdrop. We are in a unique environment where investment help is shifting away from purely speculative tech into more quality-focused names. The broader market is grappling with interest rates that have stabilized, but remain high enough to punish unprofitable growth. Thankfully, Supermicro is profitable, but the quality of that profit is under the microscope. We are also seeing a shift in how retail investors approach the market. Users on SoFi Investing and the Robinhood app are becoming more sophisticated. They are looking at cash flow conversion cycles and inventory buildups. Supermicro's inventory levels have ballooned as they prepare for this theoretical demand. If that demand doesn't materialize on schedule, they are left holding billions in depreciating hardware in a fast-moving tech cycle. It's like selling fresh produce. The longer it sits, the less it's worth. Before we move deeper into the technicals, I want to hear from you. This stock is one of the most polarizing names on the Nasdaq right now. Comment below how many shares of Supermicro Computer you currently hold, or if you sold during the accounting scare earlier in the year. Are you looking to get back in, or is the trust gone forever? I read every comment, so let me know your position. Now let's look at the Fidelity trading platform charts and see what the technicals are telling us. The stock has been stuck in a consolidation range for months. Every time it tries to break above $38 or $40, it gets swatted down by selling pressure. This $33 to $34 zone where we are sitting right now is acting as a tentative floor, but it's a fragile one. The 50-day moving average is looming overhead, acting as dynamic resistance. For the bulls to regain control, we need to see a high-volume close above $38. Until then, we are essentially in no man's land. For those of you involved in self-investing, you know that buying in the middle of a consolidation channel is risky. You usually want to buy support or buy the breakout. We are near support, which offers a decent risk-reward ratio, but the lack of a clear catalyst is the problem. The next earnings print is the Super Bowl for this company. They cannot afford another mixed quarter. They need a beat and raise to break the psychological ceiling that the accounting scandal built over the stock. We also have to talk about the institutional ownership. Fidelity mutual funds and other large asset managers have been adjusting their positions. After the governance scare, many funds were forced to trim or exit because their internal risk mandates don't allow them to hold companies with open audit questions. Now that the compliance